And we are officially going live. Today is, I don't know what today is. What is today? It's Tuesday. It's Tuesday, July 6th. Oh my gosh, I can't believe it. A, that it's July. B, that it's Tuesday already. Where did the week go? And I know you're thinking, hey, Nev, it's just Tuesday. It didn't go anywhere. It's still early on. But the moment it hits Tuesday, the moment we do the show, before you know it, the day is over. You're right there into the Wednesday, and then it's the end of the week. So time has been flying, and we have been having such a good time. But that's not what we're here to talk about. Today, we're going to talk about money because it matters. And we're going to have an incredibly amazing and important show. And we're going to be obviously take a brief look at what's been happening with the indexes in the market, just so we have an understanding of what's going on. And then we're going to go into a few stories, ending basically with why our economy is heading into a decade of depression, more or less. And we're going to be covering all kinds of cool things. I think this is going to be one of the most important shows that we have done in a while. But then again, I say that about every video, every single show, because every single show is that important. So let's do this. And good morning, good morning, good morning. I have been having technical difficulties since yesterday, so I am blaming it on a full moon or some sort of Mars retrograde or some sort of something. I don't know. But, anyways, let me know in the chat, let me know in the comments if you too are having technological issues and challenges. And, I love technology, but when it doesn't work, boy, uh, my gosh, it takes forever, at least for me to kind of go in and figure out like, okay, why are you not working? Let's figure out what's wrong and how do we fix you. So, but it is important. And I think the same question is what I had in the last financial crisis, which was basically a blimp compared to this one when it came to money. I loved when I had it and I didn't when I lost it and didn't understand what it did or didn't do and why I was having so many challenges and problems until I decided to learn how money works and how it can work for me. So now I am utilizing the exact same strategy for the computers, for the technology. Okay, it's not the exact same strategy, but the same strategy to say, I got to learn this thing of how it works. So, but today we're going to be talking about money. So let's go in and take a look. Oh no, no, no! I clicked the wrong button. Sorry about that. There's a couple of different buttons, and one allows me to sort of disappear for a second. Not that I've ever used it on purpose, so maybe I should remove it. Anyways, let's take a look at what's going on with S&P 500. And as you can see, on a 1 month basis, S&P 500 is actually on the down end. And of course, that's since early June. So as you can see, we'll see kind of how it goes. Let's take a look at the NASDAQ. NASDAQ is doing much better in a 1 month. We're actually up quite a bit since 1 month. So early June did nothing to dissuade us in the NASDAQ, which is basically 5 companies, if you really think about it. It's more than that, but 5 companies are what's driving the whole thing. Dow Jones Industrial definitely down, even more strongly than S&P 500, right? S&P 500, excuse me, you can see it up here. And Dow, it's way, way, way lower than that. Then when we switch over to gold, gold in 1 month period is actually nicely going up. So congratulations to everybody who is holding gold. And finally, let's take a look at the Bitcoin. This is a 6 month period because in 1 month period, we're actually down. June is right up here. So in 1 month, you can see that we're actually down. In 6 months, we're actually doing quite nicely. I wanted to do a little bit longer because we're seeing again this gentle slope, downish, sidewayish kind of happening. And I thought it was an important concept to kind of take a look at and consider. So that's kind of what's going on in the market. We do have a couple of different uh, news articles that I wanted to share with you, and then we're going to go into this beast of an article that we're going to use to really educate ourselves and learn as much as humanly possible about why we might be entering a depression. Because I have been talking about we are going to enter into the depression or we're entering the depression for quite a few months, and not a whole lot of people have talked about it. We're seeing more and more people talk about it, and I figured today is a great day to talk about why. What are some of the signs? What are some of the factors that might make it so? So, first thing that I want to cover is basically just some of the job opening stuff. Let me make this a little bit bigger so we can all see it and what we can expect. So, there's a JOLTS report, which is right up here explained. It's the job opening and labor turnover. JOLTS. Quite lovely. And it's a report for April, which it's lagging. All of the stuff that we get is lagging severely. Show that what you would expect, the collapse in openings and hiring and a surge in layoffs. Some industries like leisure and hospitality unsurprisingly saw large decline in openings, and the pain was widespread. Now, they actually are lagging behind the BLS, and you can see it right over here. They lag behind the BLS monthly job report by 1 month, but it captures the data for the entire month. And so this is actually important, and it's going to lead right into not this coming next article, but the article after that. So in this basically show, it is going to lead into this stuff. Now the question is how the shift is happening and how long of a road do we have to get back to the February levels. The reason they're quoting February levels here is because in February is when we had the highest employment or the lowest unemployment, right? The other side of the equation. But the challenge is that every side time we hit the top of the market and the lowest unemployment number, we get into a fiscal mess, a financial mess, every single time. Without a fail, it's just a matter of time. And this year, this time around, coronavirus and the global shutdown is what actually did it. Now, coronavirus by itself, I don't know if it would have done anything. What actually really has created the shock is the fact that we had to shut everything down. I mean, trade, everything stopped. Stop, cold. That is one of the reasons that I think the depression is coming. And again, we're going to cover it in just a moment. But before that, just a very brief thing for folks that are investors, which I think that there's going to be a few watching this anyways, of what the Fed is going to be potentially buying and what that might mean for you. As I was watching, actually I wasn't watching. It wasn't YouTube, but I wasn't watching. I was just listening while I was doing other stuff, and it was a great interview. I don't remember on whose show Jim Rogers was. Maybe Simon Dixon. I don't know. But anyways, it was a very interesting show, and Jim Rogers, if you don't know, he's an author, he's an investor. He started the fund, one of the most profitable funds with George Soros quite a few decades back. Has entered Guinness's Book of Records of touring around the world on a motorcycle and that kind of stuff. So, anyways, he's very well known and followed in many circles when it comes to money and finance and that kind of stuff. And he said something very peculiar that was very cool, and so I'm going to borrow it. And he said, "Look," and whomever he was talking with, and if you have followed Jim Rogers, then you can probably even hear it in his voice. I know I can. But he basically said, "Look, the Fed is going in, and the Fed is buying all of this stuff. Fed has way more money than I do, so if they're going to buy it, why wouldn't I buy it?" And it makes perfect sense to me because, again, remember on this show on Money Matters, we talk every single time, or close to every single time, that you want to get in right before the crowd, before when the crowd comes in, it makes the things go up, it rises it. And it's not because of the number of people per se when we talk money, it's because of the amount of money coming behind it. So Jim is basically saying the same thing, but he's not looking at the people. He's saying, well, the Fed can print money however they want, whenever they want. They can borrow and lend money, whatever rates they want, and they're going in and they're going to start buying the market. There's only one way and one place that the market can go, and that is up. So if they're going to do this and back it up, just like that crowd, a slew of cash is coming in, of course I'm going to jump in and let that wave bring me up. So there's the piece that I wanted to share with you. Fed is getting awfully close to backing Apple stock, and not just Apple. You can see right over here. I'm going to pause it for a moment. I'm going to have water while you take a look at what's on the screen. Okay, so let us continue. You probably have noticed something very interesting. The central bank secondary market corporate credit facility recently released details about its broad market index, which is basically a roadmap for which individual bonds it will buy for its portfolio after changing the rules to avoid forcing issuers to certify they're in compliance with Coronavirus AIDS Relief and Economic Security Act. So here are the companies, 13 companies that they have released that they're basically going to buy these corporate bonds. They also are changing the rules so they don't have to comply with the law. Now, the laws, basically, the regulations, or however you want to call it, was basically saying that if you get money from the government in whatever form during the coronavirus pandemic, whatever thing, you cannot buy your stock. Meaning you can't go out, issue uh, 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 a bond, right? And then use that money to go and back up your stock and buy it so that the price goes up. The Fed actually changed the rule that basically eliminates the whole like you can't buy your stock back. So we're back at buy your stock back scenario, which makes me very, very bullish for equities. I know you never thought I was ever going to say that. I never thought I was going to say that. But looking at this stuff, and I'm not saying bullish for forever, but definitely short term. Because I'm looking at this stuff, the Fed is going in, they're buying everything, they're buying corporates, and if they're going to buy these businesses, and then these businesses are able, basically, when I say buy it, I mean they're going to, hold on to their debt. It's kind of like, borrowing money from mom. You kind of never have to pay it back. I mean, that's kind of what the deal is with mom. You never pay your mom back. And if you do, it's like even a portion. And all she wants is for you to be happy and successful and do well and do nothing stupid with the money. And so that's kind of how this is working. So Fed is basically mom right now, entering the market and saying, here, 100 million for you and 20 million for you and 50 million for you. Pay me whenever. Uh, so I think that that's kind of what's going on here. But anyways, I think that this is very, very important and very, very interesting. So they're basically saying, hey, just look at the 13 companies with weighting of at least 1%, which collectively make up almost one-fifth of the index. A few things to stand out. First, there are 6 automobile companies. Interesting enough. We do have a bit of communication slash tech-ish stuff happening, right? You see Verizon, you see Comcast, then we see some tech stuff. AT&T, sorry. Apple, let's see, Microsoft are on it as well. One of the things to also pay attention to, which you may or may not have heard, is that Warren Buffett has re-entered the market. He actually has purchased quite a bit of General Electric recently, as well as entered some of the energy stocks. So again, confirmation from all sides, market is going up. Now I know this is really weird because we're going to be talking about the fact that we're entering a depression and what that may look like, but I think it's going to be a little bit of a different thing of a depression when you think through, because I think on one side we're going to see very depressed economic piece. On the other side, you're going to see this super bubblicious super high, incredibly expensive markets and assets. And that's kind of where I think it might be going into in the future. But anyways, we'll talk about it more. So one of the things that they're talking about here is Apple. And they're saying, well, there's the Apple, and it's has this huge capitalization, and it's doing really well. They have about $100 billion in debt outstanding, but it's also known to have one of the largest cash piles in the world. So the question is, why cash and why borrow? Well, here's kind of how it works. The rich people teach us something very important, as does Apple and some of the other companies. And that is, you borrow when you don't have to. You borrow when it makes sense. You borrow when that money can give you even more money. So that's what Apple is doing. They have a ton of cash, but why use cash if they don't have to when they can borrow at a super ridiculously low rate to basically get more money to do some stuff to make more money? This is how it works. So the company would basically use the proceeds from they basically go in and sell the bond, right? Which is basically borrow money. Then they go out and they use the proceeds, at least in part, but to a big part, to repurchase common stock and pay dividends. And in total, the company has doled out more than 200 billion since the start of 2018. So they're doing all right. And it's easy to see why company leadership would see it as, it's too cheap not to borrow. So basically, it costs them basically nothing to do it, but they can get all these insane returns by buying their stocks back. So now you basically have the Fed entering in and saying, we're going to buy or give money to Apple for their debt, and they're saying, "Hey, we're using that openly, using that to help finance share repurchase." And now Fed is in sort of this weird position because Jerome Powell said that the money, when they do this stuff, it's meant to be for beneficiaries are the workers, right? For all of the programs. But now they changed the rulings behind the scenes, and the secondary market facility is now coming with no strings attached. And there's every reason to expect and believe that Apple will issue bonds, Fed will buy those, and even a cheaper rate, and then they will use it to basically do buybacks and dividends. So one of the pieces that we also can expect is that Apple might not be the only one that is doing that stuff. You may experience that others will start doing that things, because why wouldn't they? If the rules have changed, if the regulations have changed, and you benefit from doing this stuff, why wouldn't you? And the challenge comes in, companies are no different than humans because they're run by humans, right? So when you see a neighbor getting free cash and able to, put in a nice deck in their backyard and improve the property, you look at it and say, well, wait a minute, I too am going to get free cash and improve my property on go on vacation. And so we start getting into the FOMO, right? And we all start jumping in. So while Apple might be one of the, or maybe, I don't know, but I am expecting it to be one of the first companies to do that. It won't be the only company to do that. I expect there's going to be many, 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 many more companies that are going to be jumping in and doing the exact same thing. And so I do expect that this is going to continue to boost on the markets. So, Robinhood Army, you were right, and more money is coming to support you. Just pay attention to what you're buying, and as long as you're buying what Fed is buying, you should be fine, because they're going to keep on backing that puppy left, right, and sideways. And as long as the music is playing, you should go dancing. Again, not a financial advice, but just the way that I am processing stuff. And of course, you can and should do your own research and consider what does or doesn't make sense for you. And now it is time to make a change and a shift into a new article that I want to spend the rest of the time talking about and discussing. But first, hydration, and then we go. I don't know why, but there are mornings where I am perfectly fine. I don't have to drink any water when we're doing this stuff. And then there's mornings where I'm like, I could drink the entire glass and still drink more. Anyways, so now we're going in and saying why our economy may be headed for a decade of depression. And we're going to be talking about this is an article, it was basically an interview with Nouriel Rubini. And he is a professor at New York University, NYU. And he's also served in many different roles. But without going into further ado, let's go in and talk about what this article is all about. We're going to make it a little bit smaller so it all fits nicely on the page, and we can talk about it. So he is also known as Doctor Doom. I did not know that, but there you go. And he is a bear once again. While many investors bet on a V-shaped recovery, Rubini is staking his reputation on an L-shaped depression. Very similar to what I have been calling and talking about as well since, I don't know, March. Uh, he's basically argued that the massive private debts accrued during both the 2008 crash and COVID-19 crisis will durably depress consumption and weaken the short-lived recovery. The aging population across the West will further undermine growth while increasing the fiscal burdens of the state already settled with the hazardous debt load. That kind of makes sense, right? If you think about it, because if you have a lot of that and more people need more stuff and not many jobs are coming in and all of the things are they're shifting, like you get squeezed on multiple sides. As the deepening geopolitical rift between the United States and China triggers a wave of deglobalization, negative supply shocks akin those of the 1970s are going to raise the cost of real resources, even as hyper-exploited workers suffer perpetual wage and benefit declines. Prices will rise, but growth will peter out, since ordinary people will be forced to pare back their consumption more and more. Stagflation will beget depression. So, I want to talk about this for just a moment and kind of how it, like, what does it all mean? Like, what are we talking about here? And of course, we do know the whole challenge with the geopolitical risks, right? We are seeing that U.S. is kind of going back and forth with China on many different things. There are different kind of trade wars, currency wars, all kinds of other things happening. Prohibition of certain technological devices kind of coming in. Uh, we have tens of millions of people that are unemployed. And while some of the jobs are starting to come back, not a lot of them are. And many jobs that are going to be re entering the markets are going to be paying less and hiring for fewer hours, doing like gigs, contractors, that kind of stuff. And here is why. As a business, your one of the biggest expenses that you have, and also potentially returns on investment, is the labor, right? Labor is very expensive in developed countries. In United States, it's very very expensive because you got to pay somebody their salary, then you got to pay the benefits. Then there's all these different payroll taxes and all this different stuff that is happening that also comes in. Now the employee doesn't get that, but the employer definitely feels it. So, for example, to hire somebody at say $40 to $45 salary, uh, the business has to basically account about $60,000 in expenses, right? So employee gets 45 salary, but of course they don't get all of that. So take the taxes out. Their real income might be, I don't know, 37,000, but the business has to pay 60,000. As you can see, all of the stuff between that 60 that the business has to pay, between benefits and all of the stuff that we talked about, and what the employee gets after taxes, there's a huge gap. And that gap goes to fund, goes to pay the taxes, but also goes to fund all these different government sponsored things that exist out there. So that's a huge problem. So a cheaper way to do stuff is to go back and say, Bob, coronavirus has done a number on the business. We're going to have to cut the hours. We're going to have to cut your salary by 20%, and we're going to have to cut your benefits. I am very, very sorry. Now, Bob, of course, has an option to say, thanks, man, no thanks, I'm out. But he won't because he'll land on the unemployment. And while right now, the unemployment, you do get that extra $600 benefit per week. Uh, that is set to expire in 3 weeks, y'all. 3 weeks, less than 3 weeks, actually. For many, as we talked about, is going to expire on 25th or 26th. And unless the government kind of passes something new, but it doesn't look like they're doing much of anything because it's summer and they're about to go to recess because, Hamptons is waiting, and I don't know if that's where they're going to go, but that's kind of what I'm thinking is going to happen. So now Bob is basically challenged. Do I go and say, forget it, man, go on unemployment and get peanuts? Because I also know that there's an army of unemployed people behind me that if I say no, there's going to be like thousands of people applying, and I, as a business, I can pick whomever I want and offer even less. So Bob says, sure, man, I'll stay. This sucks, but I'll stay. So now the business, whether they need to or not, is going to do this. And you're going to have some business that are saying, forget it, Nev, I'm not doing it. I have ethical, legal, moral obligation to go in and to actually, uh, you know, uh, uh, set things up and help people out. And, I'm not going to shortchange people at all. That's unfair. I don't like that idea. Sure, you don't have to. The problem is that businesses compete with one another. So if you have five businesses and two out of five end up doing what I just shared, where they're going to cut their labor costs by laying some people off and then cutting everybody else's salaries, hours, benefits, and shifting things in all kinds of ways, uh, they're going to become much more competitive, right? They might be able to keep the same salaries, for example, the same prices, for example, right? But their margins are going to be wider, meaning they're earning more. If they're earning more, they're able to save more. If they're able to save more, they can borrow more if they need to, if they want to. And so they become much more solid company. They can survive the upcoming sort of snowball of a economics that we're all going to experience and are experiencing right now. So the other three are going to see this. Eventually, one of them is going to say, whoa, 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 whoa. They're making way more money. They can also compete with us by cutting the prices so they get more customers, right? Uh, and they can still make more money even if they cut the prices, but we can't. We are suffering. Um, and so they're going to start cutting as well. So what I'm saying is this is the reality of what we're going to see, and this is the reality of what we're already seeing, that companies are saying, I'm going to bring people back, but I'm bringing them back part-time. I'm bringing them back as independent contractors because as an independent contractor, I don't have to pay all of the benefits and all the other stuff that I do when it is an employee. You're going to be hired as a gig worker and that kind of stuff. So we're going to experience way more of that. And so that's kind of going to be problematic. So now you're going to have a regular employee, let's call him Bob. And Bob is now, instead of going from 40 hours a week working for one company, full time, full benefits, full everything, 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 to working maybe 40 hours if he's salary, but making 10% less or 15% less on a larger scale because there's no increase, in the benefits get cut, the salary stays the same or gets cut, but the expenses keep on rising. This is now becoming what I call the short squeeze, right? You get squeezed and you are short on everything. So now Bob is forced to go and get a second job to basically make the difference or borrow more to make the difference. When this happens, he's going to be forced at sooner or later to actually consume less. When he consumes less, it means that some business somewhere won't get his business, so they will have to cut even more. You kind of see where this is going, right? So let us continue with the article. So that's kind of what this basically whole thing is talking about. And we're going to talk more about the deglobalization and what it actually means, right? What does this actually mean for us as investors, as business owners, and so on? Now, the prediction, what he's saying, and it's the same for me, it's not for 2020 the year, it's for 2020 the decade, right? So, and it's basically saying it's going to be an even greater depression. My view is that there's going to be a meaningful correction once people realize there's going to be a U-shaped recovery, not V-shaped. If you listen carefully to what Fed officials are saying, or even what JP Morgan and Goldman Sachs are saying, initially they were all in the V camp, but now they're all saying, well, maybe it's going to be more of a U. And here he's talking about the market and the fact that it's decoupling. And you can see that we've gone from a sharp rise to sort of slowing things down and kind of hitting that. I call it the hill peak, where you come onto the peak of a hill, not a mountain, right? We're talking a hill. It's just that gentle slope, and it's kind of starting to go in, and now it has a potential to either go sideways, down, but not the probability of it going like straight up. I don't know. Again, this also goes a little bit in a contrast because it was assuming. Hold on, y'all. The neighbors are cutting grass, and it's very noisy, so I don't like it. Uh, but what I was saying is that, but the Fed is kind of coming in and pumping the money, and so when we look at that hill, that's sort of like all things being equal, but all things are not equal because Fed is coming in is going to definitely make some of the companies um, improve their financials and their potentially stocks as well, at least short term. Tons of people are going to lose unemployment benefits in July, and if they are rehired, they're not going to be like before, formal employment full benefits, only on hourly basis with no benefits and low wage. That's what every business is going to be offering, and we just talked about this stuff, right? We talked about sort of why and how that will work. And to be honest with you, because of my work and my business and everything else that I do, I am seeing this from more and more businesses that this has already happened. One by one, businesses are starting to send these formal memos and letterheads and all this different stuff to their employees and saying, hey, we are going to lay off 10% of our workforce, and then 90% stays. And they were like, we're going to furlough 20%. You're like, oh, great. Now we're down to like 70% of us, but the work more or less stays the same. And then you get the letter that says, there will be no increase in salaries whatsoever. And you were like, okay, great. Then you get another letter that says, uh, those benefits about the 401k matching? Yeah, we're going to stop that. Sorry. Then you get another one, be like, yeah, you know how you get like the health and dental and stuff? We're changing all of that stuff. I mean, you still get to keep the benefits, but your copay is going to go through the roof. And so all of those things are coming, and we can expect it. And like I said, some of the pricing on some of the stuff is not going to go down. Some might, but some will definitely go up. And we'll talk more as to why that is coming in the near future. Okay, so you got to stay tuned in. Like I said, this is probably one of the most important shows that I talked about. We do have that CLO stuff that we talked about that is incredibly important. This is hugely important for you to understand the economics as a whole of what we might be experiencing. And I say might because I don't know for sure what is going to happen, but it's more likely than not. Okay. So it's important. It's very, very important. You got to pay attention to this. And do me a favor, if you are watching this on YouTube, uh, hit the like and do share it with people because I want to make sure that more people get this stuff. Like I said, it's very, very important. And more people know this, more people can start preparing for what is about to come so that they don't get surprised and shocked. Okay? All right. So, uh, so they're talking over here that the people are talking about like, well, the unemployment benefits, when employment benefits expire, lots of people aren't going to have any income at all. Those who do get jobs are going to go to work under more miserable conditions than before. And they're going to be cutting discretionary spending because they're earning more money. And you also have to remember that in an economy, one person's spending in another person earning, and that person earning is of course another. So it's a cycle that if I don't earn money, I can't spend money. If I can't spend money, all the businesses that I was going to spend money on can't earn money. You see kind of how it works and why it's a big problem that kind of follows kind of like a Lego, like it stacks on each other, right? Uh, in Germany and China, they've already been open for a while. Look at any survey, the restaurants are totally empty, almost nobody buying anything. And this is in Germany when unemployment is up only 1%, right? So Germany jumped only 1%, and yet not much is happening. And it's similar here where I live. Again, I don't know where you live, where you're tuning in from. So let me know what you're seeing in your area. Please do so in the comments, in the chat, for those of you that are watching this live. Uh, Let me know what are you seeing because just yesterday I was, oh my gosh, y'all, I was hunkering for pizza, and it's important. It's connected, I promise. And so I don't do pizza very often, if ever, because of multiple reasons. But anyways, I was low in spirits in that regard, and I was like, forget it, man. I'm just gonna have a pizza. So I ordered pizza for pickup. Drove over there. Of course, the traffic was a snooze. Drove over there, went into the pizza place. Right now, where we are, they can't have well, this pizza place, no customers on the inside. They don't have any outside seating, so it's basically zero people in. There were three employees when I walked in. Two were basically going to work over there, like making the pizzas. One was sort of that, like taking orders and that kind of stuff. So three of them, completely empty. I ordered my pizza. My pizza was ready to go, and it was the only pizza there. And we're talking like 4 or 5 p.m. in the afternoon, so basically end of the workday, kind of thing happening. And I said, like, how many orders do you guys get? Because I was just curious, right? Because of what I do anyways, but I'm also curious in nature. And I said, like, how many businesses do you guys get? Like, wow, you look dead. And they were like, yeah, you were the first order of the day. What? So when that is happening, guys, breaks my heart. But I don't see this pizza place surviving, and it's horrible because they do make good pizza, and I don't eat it often enough, so I definitely don't support it often enough because I can't. But that just sort of drives that piece. And then we look at the other restaurants that are doing this stuff, and I mean, they're getting 10, 20, 30% of what they used to get, and their margins are small anyways. So now you compare all of that stuff. I don't see how this pizza place is going to be able to keep three people hired. I think one person is going to be plenty if you're getting only a handful of orders per day. So it's going to basically the person that knows how to answer the phone, how to deal with customers, and how to make the pizza, right? That's kind of how it's going to be. Now, I don't know if that is going to happen, but that's what I presume will have to happen if the pizza parlor is to survive at all. And that's going to go for all the other restaurants and businesses and everything else. You are going to start having food riots soon enough. We're already starting to see riots, but not food riots. We're one step away from food riots. There are lines 3 miles long at food banks. That's what's happening in America. My argument for why inflation will eventually come back is not just based on US-China relations. It actually has 14 separate arguments for why this will happen. Everybody agrees that there's beginning of a Cold War between US and China. The tech war will become a trade war. So now they're saying like this trade war is turning into a tech war with the whole like Huawei and 5Gs and all of this stuff. And we've been talking about it on the show here. So it shouldn't be surprising to you. Start connecting the dots, y'all. And if you haven't watched the previous shows, make sure you watch it on YouTube. The channel has all of the historic ones, so you can definitely binge watch and catch up to what's happening in the world and why this stuff is really, really important, why we even cover it. Every piece of consumer electronics in the future, right? Coffee maker, microwave, toaster, your Rumba, everything is going to have a 5G chip. And that's what kind of what the Internet of the Stuff is. So everything is going to be equipped with the 5G. Everything is going to be connected to the internet. And here is the interesting piece that is happening that we're going to talk about in a moment, is that when you take Huawei's 5G chip out and you put Ericsson's, for example, nothing against Ericsson, good company, but the Ericsson's is, what, like 5 times as expensive, and a quarter, or like half as productive, as powerful. So you're paying more for less, right? And so start doing the math in your head before we get there, of like, what does this actually mean? But let's continue with the article. Historically, these things have led to a hot war in 12 out of 16 episodes in a 2,000-year history. So we'll be lucky if we only get a Cold War. This is the reason why I'm talking about that. I'm very, very worried about where this is all leading to, and a high potential that we might enter yet another global war. That's kind of where my fear is. And now you understand why, because we're starting Cold Wars all over the place, everywhere. Uh, when you reshore, so he's talking about now, it's like, well, it's going to get better because companies are going to come to US, right? And we're going to big factories and we're going to employ people and everything is going to be great, right? Right? Not so much, y'all. Not so much. When you reshore, you're moving production from regions of the world like China and other parts of Asia that we have a ton of low labor to the parts of the world like US and Europe that have very expensive labor costs. We just talked about it. They're going to replace labor with robots and AI. Now, Hyundai, the third largest automaker in the world in South Korea, basically said that the very next day they could switch their factories to run on robots without workers. Now, you take production from a labor intensive factory in China, move it to a brand new factory in the United States, meaning we're just building it. There's no history, there's no legacy, nobody owes anybody anything. You design the factory to use as few workers as you can, and you put basically all these robots. So it's going to be capital intensive and labor saving. And basically, reshoring means that you are increasing production in the United States, but you're not increasing employment. So the company might, we might become more productive. The company might make more money, but it's not going to create more jobs. I think people are kind of stuck thinking in the historic piece to say, well, of course, if we have factories, that means we have factory workers, and factory workers means more employment. No, 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 no. You don't need workers to have a factory anymore. It's all machines. It's all machines. And it's smart machines. They can actually start thinking for themselves. How crazy is that? But you're not going to basically get main things. And, he's basically saying that eventually even the person cleaning the floor is going to be replaced with some sort of robot like Rumba, because Rumba can work around the clock. You pay for it once. Occasionally, like might tweak it or dust it or whatever, upgrade it. But you don't have to increase salary, no benefits, none of that crazy stuff. And it works around the clock. Duh. That's the direction of where things are going. Now, people think that there's correlation between what's good for Wall Street and it's good for Main Street, because you were like, well, production is going to go up, so Wall Street goes up. That means everybody's fine. No, 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 no. It doesn't work that way. And now we're going to understand why. Because remember 2008? We did a lot of things in 2008 that was very, very good for Wall Street. And they said, well, we got to save the Wall Street because it's going to trickle down to Main Street. But it's not trickling, y'all. It never did. It never will. Okay. So they're saying we got to bail out the Wall Street because Main Street is going to collapse. But Wall Street, how did they react? They fired workers, right? Think back to 2008. They fired everybody. They got bailed out. They got saved out, and then they rehired them. But they will rehire them on part-time basis, gig basis, contractor, freelancers, all of this stuff. So that's what happened last time. What makes you think that something new is going to happen this time, right? And now we're talking about, last time we talked about, a handful of million. Now we're talking like 40 million or 31 and a half as of the last report that we talked about on the show. So when they start rehiring, it's going to be super slow. It's going to be part-time, no benefits, no high wages. Like, it's going to be bare bone minimal. And you know what? when you are living on unemployment benefits of, say, uh, 1,500 a month, and somebody offers you $1,800 a month job, you take it. You take it because it's $300 extra that now you can actually pay for food or pay for something. So we're going to see this stuff. So everybody is going to be slashing labor costs. Household goods are going to have way less income, which means less consumption. Less consumption means, slowing down economy. Now, uh, what he's basically saying here, and he's saying the same thing. So consumption is going to be weak. For decades, workers have been screwed. Now they're going to be screwed even more. Millions of small businesses are going to go bankrupt, and Wall Street is going to win. I've been calling Wall Street Casino for forever because they always end up on top. They always end up winning. And the reason that millions of small businesses are going to go bust is because there's not going to be consumption, so nobody's going to be buying stuff, and you can't go in and do stuff. Now, here's the piece that we talked about that I just mentioned, kind of how and why sort of the challenges with some of that 5G technology is going to happen, and kind of what's going on with the GDP. So this time around, it's short term. It's both supply and demand shock. We've already talked about this stuff, and people have been talking about it for a while, but I want to make sure you understand. If you want to avoid the depression, you need to do monetary and fiscal stimulus. Once you run a budget deficit, not 3, not 5, not 8, but 15 or 20% of GDP, you're going to get fully monetization, because that's what Fed is doing. But you still want the inflation in the short run, because you have slack in goods markets, slack in labor markets, slack in commodities, etc. So he's saying we're not going to see inflation for a couple of years, and I've been saying the same thing. Now, there will be inflation in post-coronavirus world, because we're going to see two big negative supply shocks. For the last decades, prices have been contained by two positive supply shocks: globalization and technology. Now, globalization is becoming deglobalization. We're seeing it unfold before our eyes. It's disappearing. And technology is not going to be same as before. 5G of Ericsson or Nokia costs 30% more than one of Huawei, and is 20% less productive. So to install non-Chinese 5G network, we're going to pay 50% more. So you have two major forces that have been exerting downward pressure on prices, moving in the opposite direction. And now you also have massive monetization of fiscal deficits, right? So he's saying, remember 1970s, you had two negative supply shocks, 73 and 79. And that's, what did we get? We got stagflation. Now, I'm not talking about hyperinflation, not Zimbabwe or Argentina. Many people have been talking about that. I don't think that that's going to happen. I agree right here with the Ruben. Uh, I'm not even talking about 10% inflation. It's enough for inflation to go from 1 to 4%. I know it sounds crazy, but hear it out. Hear it out, right? In the fourth quarter of 2018, when the Federal Reserve tried to raise the rates above 2%, the market couldn't take it. So we don't need hyperinflation to have a disaster. Just imagine, right? You have all of this borrowing that is happening, right? People are going in, which means bonds, all of that stuff. So now imagine that they reflate and say, well, instead of earning, 0.5% interest, which means somebody has to pay that 0.5% interest, you're going to earn 4% interest. Whoa, 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 whoa. Not going to happen. Not going to happen, because you can't afford to pay that kind of money, right? So it's simply not going to happen. It's problematic, highly problematic. So for the last decade, debt to GDP ratios in the U.S. and globally have been rises, and debts have been rising for corporations and households as well. But the second the Fed started to hike rates, there was panic. The economy couldn't take Fed funds rate of 2.5% in the strongest economy in the world. This is the whole concept of like 2008 till 2019, when we tried to sort of stop printing and actually start increasing the rates. And what happened? Everything started breaking down. It's kind of like, Your car is held by duct tape and strings and sticks and that kind of stuff, and you went from like 1 mile an hour trying to go 3 miles an hour, and everything starts shaking and falling apart, and you lost the wheel. That's basically what happened. That's basically what's going on. The economy couldn't take Fed funds rate of 2.5% in the strongest economy in the world. There's so much debt. If long-term rates go from zero to just 3%, the economy is going to crash. So that means we can't raise rates like ever, 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 ever. So this is where the problem lies. And this is kind of what we're going to experience. So how do you prepare? That's an interesting concept. How do you prepare? Well, one of the things that you prepare for is by educating yourself, staying informed with the channel like Money Matters, watching live, whether on onedealaway.com or watching on YouTube. Make sure you subscribe, hit the bell button so you don't miss the show, and do give a thumbs up. Do me a favor, please. Hit the thumbs up and share this video, please, because it is important. Second thing that you need to do is you got to study. You got to learn how these things work. We do a lot of the stuff here, but not everything. So you got to learn how to invest better, how to become a sovereign individual, how to take care of your finances. You got to figure out how do you eliminate some of these debts that maybe are on pause right now, but are going to come from pause and are going to run rampant and are going to hurt even more people even faster. So you got to learn all of those things. You want to invest in real assets. Maybe real estate could be part of it, but it has its own risks, right? So you need to understand all of those things. Do you go into put some gold? But does it make sense? And when does it make sense? Do you jump into the equities? Do you hold on to the bond? Do you go into the crypto? And how does all of that work? So all of those things are things that you absolutely need to learn. If you're interested from learning for somebody like me, by all means, go to onedealaway.com, check out the courses. May I recommend the Academy because it has everything in it for one super low monthly price. You can cancel anywhere, anytime, anywhere, I guess, too, and you don't have to worry about it. And the final piece is you got to stay informed and you got to take action on some of these things. You want to absolutely want to save up a little bit of money right now as we're going into these depressionary cycles. But then once we hit that hyperinflation, or inflation for that matter, not just hyper, your cash is going to start losing value fast. So you want to be able to flip it really quickly into things that make sense. And for all of that, you got to have this working and operating. But in order for this to work and operate, you got to feed it good information, and you get that from education. That is the reason why I am so passionate about education. And I do invite you to come and check out the Academy on onedealaway.com. So thank you for watching. Super long show, I know, but it was super, super important. We're going to go live and into the chat right now for the Q&A for everybody that is watching live for at YouTube. Thanks for watching. Until next time, stay forever money blessed. And do remember, you are only one deal away.